hierarchy, what in Europe we tend to call eligible liabilities. But the point I want to make is that for large banks, we've reinforced the assurance of deposits by requiring a bigger cushion of loss-absorbing liabilities. But smaller banks find it harder to issue marketable long-term debt securities that can count as eligible liabilities. So I think we do have to go back to this question of the balance and practicality of, where is that sort of tension best, in a sense, resolved? Is it in the world of deposit insurance or is it somewhere else? I welcome the fact that the US authorities have announced a review of the deposit insurance system. In the UK, we are considering improvements to the approach to depositor payouts of smaller banks which do not have eligible liabilities. So far, we've focused on speed of payout, but going further and considering increasing depositor protection limits, I think is an issue we will have to consider, but we will also have to consider the cost implications for the banking sector as a whole. And we have to come back to the point that in bank resolution, I'm afraid there isn't a free lunch. That problem has to be sort of addressed full on. Right, you'll probably be pleased to hear I've got two more things to talk about, then I will shut up and sit down. The first is a key part of how we underpin financial stability, how we assess and test for stress. I think one of the important implications, innovations since the financial crisis has been stress testing. It's critical and it needs to be thorough and cannot be sidelined when the consequences may be awkward. But there are difficult issues surrounding how to set the parameters of stress tests, how much stress to assume. We tend to calibrate stress tests on the basis of history plus something added on, but the something can be hard to judge. As a case study, that's what we did in the Financial Policy Committee of the Bank of England's work on liability-driven investment in pension funds after 2018. But what we know, though I don't think we always say, is that this sort of approach does not pass the black swan test. That is one in which the future is not implied by the past and isn't forecastable. That does not mean to say, because it is the case, that on its own a stress test isn't a very useful and essential part of the toolkit. It is. But we know that we can't envisage and design tests that capture all possible future states of the world, and I don't think we should pretend that we can. Rather, we must stress up to the point where it's sensible for regulation to create the protection we want, and this is a crucial point, I think, we must have other approaches that cover the world of risks beyond that point. So these, of course, are bank resolution tools, and central bank intervention tools of the type we had to use last autumn in the non-bank world. So last, well, as Tim said, the last issue is the small issue of non-bank finance. Given the increase in bank regulation required in the aftermath of the financial crisis, it's not surprising in my mind that the last decade has seen a relative and absolute increase in non-bank finance. One important way to look at the bank versus non-bank world is that in the former, there is assurance on the value of money as the main liability of banks, while in the latter, the value of investments explicitly and deliberately is not assured. Now that's important, but we have to recognise that the growth of non-bank finance has led to the significant expansion of the landscape of systemic risk since the financial crisis. In other words, the non-bank world can transmit risk into the bank world and to other parts of the core of the financial system, like central counterparties. Consequently, the relative focus of our financial stability work has shifted to the risks posed by the non-bank financial institution world. And I would add that I think a common theme running through the incidents that have occurred in recent times, the dash for cash in 2020, the Archegos collapse, the LDI pension fund issue that we had, the nickel market metals case, the common theme running through that is that for firms to understand and respond to the full risk implications, they would have had to observe and respond to a much larger picture of risks than they could observe from their own positions. And from that, once you did observe that much larger picture, came potentially much larger risks. Now, one thing that's abundantly clear is that the NBFI world presents a challenge of what I call breadth and depth. It's a very large landscape, it's a disparate landscape, so many activities, many entities. So we have to survey a lot of ground to look out for the risks. But the depth point is relevant because in order to understand these risks, we need to get into the detail. LDI for us was a good case study of this. The LDI fund world comprised 85% of the larger so-called segregated funds and 15% of the smaller pooled funds. Our work on stress had focused on the 85%. The problem turned up in the 15%. So in some ways, these issues around non-bank finance bear a striking resemblance to ages-old challenges in finance, such as leverage and interconnectivity with other parts of the system, creating the scope for spillovers and for systemic consequences. But the heterogeneity of the landscape means that there's no single magic number for leverage, as we have with banks. And the interconnectivity can be hard to map, reflected, as I say, in recent incidents. Now that helps to explain why at the Bank of England we're conducting a system-wide stress exercise involving non-banks as well as banks to help to map out and understand those risks. I would also add that non-bank finance is inherently a cross-border issue. So we have to make progress internationally, and this is what the Financial Stability Board work programme is focused on and why it's so important. But it's also crucial that individual countries take forward and implement the reforms. While the solutions may be global, delivering them into practice will necessarily be local. Finally, there's an important point to pull out of a number of these issues. A common outcome of a shift in the balance from inside to outside money, whether it's CBDC, banks holding larger reserves at the central bank, or increasing the broader liquidity buffers of banks and non-banks, could be to create a constraint on lending and investment in the real economy. I can certainly say that for the UK economy, this would go against the need to finance investment to support stronger potential growth, which is currently at a weak level. Now, this constraint would not appear if the counterfactual was an unstable financial system, because solving that instability would have to be the priority. But in the more stable world, which I believe we're in, public policy must still determine the best use of tools. So, for instance, advocating ever tougher stress tests and larger liquidity buffers in an attempt to cover future black swans is not obviously preferable to having tools by which central banks can make temporary and targeted interventions, as we did last October. The point I want to make is that it underlines, that strong institutions of prudential policy, macro and micro, are important, and that we need to have a very extensive and well-developed toolkit which we can apply, in the different circumstances we face. Now, I'm going to stop there. I'm not going to go through all the points I made. There's quite a lot of them, but I think I do have a slide. I don't know when it's going to come up. Oh, here we are, which you'll say is ridiculously small in print, which just tries to summarize the points. It's saying going over this very big landscape, which hopefully may be useful for the follow-up discussion. Thank you.
Thank you, Governor Bailey, and thank you for the slide. I'll make copies of that and put it in my jacket pocket and carry it around with me. It's a nice summation of a very thoughtful analysis. So why don't we next turn to our second speaker, Governor DeCos.
Thank you very much, Tim, and thank you to the IIF for a new invitation to be here. So let me try to complement with my hat of chair of the Basel Committee to what Andrew has just said, and I will try to focus my remarks on one specific topic, which is the recent episodes of banking stress and the implications for the Basel Committee work, with, of course, a more micro-prudential and regulatory perspective, as I think will complement well what Andrew said. It was more a macro perspective. So I think we should start by saying that this was perhaps the first real stress test of the banking system since the global financial crisis, because, I mean, we all know that the pandemic was, first it was a completely exogenous shock, which was not endogenous to the system. I think this is, of course, very, very relevant. And then second, we also know that the banking system benefited from the huge scale of public support applied by different governments and policymakers in general, central banks in particular as well. So I guess it is important to take a step back and ask what happened, why it happened, and what it all means for banks, regulators, and supervisors. And as you may have seen, the committee, the Basel Committee, recently announced that it is reviewing recent market developments and will take a stock of the regulatory and supervisory implications from recent events with a view for learning lessons. This work has already started, and the committee will discuss the outcome of this work in due course. So in the meantime, what I will try to do today is speaking strictly in a personal capacity, offering some preliminary observations and raising some questions. There will be more questions than answers, I can anticipate you. And of course, I will not prejudge the outcome of the committee's stock take, and I shall also refrain from commenting on individual banks or jurisdictions. So I guess it's obvious to everybody that there has been no shortage of commentary on the recent turmoil in the banking system. Fingers have been pointed at banks' risk management failings and ineffective governance, including with regard to MB5 exposures, interest rate risk, and liquidity risk. Some commentators have been quick to highlight regulatory and supervisory frameworks. Others have made statements about risks to banks, and the committee itself has been warning about the risk to banks from rising interest rates and a worsening macro outlook for over a year now. And alongside the committee's own stock take, many authorities are also in the process of reviewing the past few months and the lessons learned. So first point I wanted to make is that the reality is, at least the reality for me, is that there is unlikely to be a single culprit that will be revealed at the end, and instead multiple factors are likely to have contributed to the stress episodes, with numerous implications for banks and also for supervisors and regulators going forward. What's more, I think history also suggests that it may take more time to have a complete picture and assessment of what happened, why it happened, and where do we go from here. So this first observation today is that we should be humble and open-minded at this stage when it comes to assessing recent developments and implications, and we should not hastily jump to conclusions, we should close any doors. And of course, once our stock take is completed, remedial action should be taken if, of course, deemed necessary. So with this caveat in place, my first preliminary takeaway from recent events is that we need to start by asking why, in 2023, some banks have failed to meet basic risk management and governance practices. To be clear, this is not a general pattern across the banking system and is more of a tail event. But in times of stress, we also know the financial chain is only as strong as its weakest link. Sound risk management and robust governance practices are the bread and butter of bank management. Banks should be the first port of call in managing and overseeing risk. These functions cannot be outsourced to supervisors. Thus, jumping straight to discussions about the regulatory and supervisory implications of recent events is akin to forgiving banks for not fulfilling their primary responsibilities. The essential role of these banking building blocks has long been recognized and articulated by the Basel Committee. For example, the Basel framework, I'm here just quoting, stipulates that bank management is responsible for understanding the nature and level of risk being taken by the bank and how this risk relates to adequate capital levels. It goes on to note that bank management is also responsible for ensuring that the formality and sophistication of the risk management processes are appropriate in light of the risk profile and business plan. And these supervisory expectations are, of course, complemented by a set of additional guidelines on corporate governance principles for banks worldwide, which cover banks' risk management functions and the role of senior management and the board. Meeting these guidelines should not be a box-ticking exercise, but rather should take the form of a deeply embedded mindset at all levels of any bank. These banking basics also apply when it comes to the fundamentals of risk management and oversight by banks. A bank's board senior management and risk management functions should be asking themselves questions in a timely fashion and taking credible measures to increase resilience. They should respond promptly to material developments such as the rapid growth of a bank's balance sheet, an excessive reliance on a limited set of revenue or funding sources, ineffective asset liability management, a growing number of misconduct incidents, changes in the economic environment such as expected changes in interest rates or economic growth, or the inability to consider a broad set of what-if stress test scenarios. So let me now move to supervision. And here I will limit my remarks at this stage to an observation and a question. First, my observation. The degree of cross-border supervisory cooperation at the level of the Basel Committee in response to recent events has been effective, and jurisdictions cooperated throughout recent banking stresses to help restore financial stability, and the committee itself held several meetings to facilitate the exchanging of supervisory information and cross-border collaboration. But, and I think this is important, we should not take this for granted. And building on the committee's almost 50 years of facilitating and promoting global supervisory cooperation, we should always seek opportunities to continue to improve on this front as needed. And now my question. As memories fade and complacency sets in after each banking crisis, how can we best preserve the strength and robustness of supervision over time? And to be clear, I'm not referring to the willingness of supervisors themselves to oversee banks, identify failings, and challenge management effectively. Instead, I'm referring to the broader environment and the extent to which it facilitates or hinders the ability of supervisors to take decisions that may be unpopular. In this regard, supervisors should be encouraged to ask tough questions and take decisive action to ensure the safety and soundness of banks and to safeguard financial stability. These are public goods, it was also mentioned by Andrew, for the benefits of society at large. The privatization of banking gains and socialization of extreme losses is not an acceptable outcome. At the same time, the rewards from the tough supervisory decisions necessary to avoid banking crises are rarely visible or clear. We never see the counterfactual. In other words, supervisory success is an orphan. So it is critical that all of us welcome and support the ability of a supervisor to exercise its judgment and tell a bank that its leverage or maturity transformation is too elevated, or that its business model is unsustainable, or that it needs to adopt prompt and substantive measures to shore up risk management and governance failings. So let me add and finalize with three remarks on the regulatory implications of recent events. First, I think it was also mentioned by Andrew, we've again been reminded of the critical importance of having prudent and robust regulatory standards for bank capital and liquidity. The implemented Basel III reforms have greatly enhanced the resilience of the global banking system. It was the first bullet point that was stressed by Andrew, with total leverage in the banking system halving from about 30 times to 15 times since 2011. Banks' holdings of liquid assets have more than doubled during this time period and now stand at $12.5 trillion. So, in other words, these reforms have helped contain the fallout of the recent banking stress events. In this regard, the benefits of the multiple metrics nature of Basel III were also in full evidence. The inclusion of a leverage ratio, large exposure limits, and two liquidity standards as complements to the risk-weighted capital ratio in Basel III is intended precisely to create a regulatory framework that is more robust to arbitrage and erosion over time, as each measure offsets or tries to offset the shortcomings and adverse incentives of the others. Let's take the example of the liquidity coverage ratio. The liquidity coverage ratio standard includes a series of monitoring tools of banks' funding concentration, contractual maturity mismatch, and asset encumbrance. The standard makes clear that together, and again quoting, that together with the LCR, these other elements provide the cornerstone of information in assessing the liquidity risk of a bank. So all in all, authorities, market participant analysts should rely on the full suite of Basel III metrics, including the leverage ratio and capital measures based on common equity tier 1, when assessing the relative capital and liquidity strength of banks. Second point, it is absolutely crucial for policymakers to guard against the perils of the regulatory cycle when designing and implementing standards. Memories of banking crisis fade over time, whether because of the mere passage of time or due to succeeding events. Best interests start to gain momentum. We convince ourselves that some reforms may no longer be needed or warranted. But in fact, many of the potential regulatory shortcomings highlighted by commentators these days have already been considered at the international level. Let me give you two examples. The committee initially proposed the adoption of a uniformly applied Pillar 1 measure for calculating the minimum capital requirements for interest rate risk in the banking book. It had also consulted on the design and calibration of the liquidity coverage ratio, including a series of relatively conservative liquidity output flow factors. In both instances, these proposals were eventually revised, influenced by stakeholder input during the consultation periods on the perceived overly conservative nature of the proposals and the role of banks' own risk management practices. To be clear, I'm not suggesting that the original calibration and design would have been prevented any future bank stress. The aim of this reform is not to create a zero-failure regime, but it is clear that they do have been helped reduce the likelihood and impact of such events. More generally, the committee's standards are intended to be a minimum global baseline. Jurisdictions are free to go beyond them and encouraged to do so, depending on the characteristics of their banking systems. So, as we proceed with the stocktake and consider the regulatory implications of recent events, it will be important to filter out the noise from the signal and not to forget the lessons of both recent events but also of previous banking episodes. My third remark is that the financial stability benefits of Basel III can only be secure if the standards are implemented as intended. This means both the full and consistent implementation of Basel III standards and their application to international active banks. And the committee recognizes that depending on local circumstances, it may be appropriate to adopt a proportionate implementation of Basel III for non-international active banks. And you perfectly know the exact scoping of banks that fall into the international active or non-international active groupings is left to member jurisdictions. But the committee has also stressed that all banks should be subject to supervision commensurate to their risk profile and systemic importance. And as recent events have reminded us, there are multiple dimensions of the systemic importance of the failure of a bank, including both first and second route propagation effects. And we have also underlined that proportionality should not seek to dilute the robustness of standards, and that any simpler proportionate approaches would need to be more conservative to compensate for the lower risk sensitivity. So in conclusion, I think it's obvious, at least obvious to me, that recent events have further highlighted the importance of a resilient global banking system underpinned by effective bank governance and risk management practices, robust regulatory standards, and strong supervision supported by proactive cross-border cooperation. It is vital for banks and supervisors to remain vigilant to the evolving outlook. The risks of high inflation, lower growth, and geopolitical tensions remain as relevant today as they did in early March. And in this context, implementing the outstanding Basel III standards in a full and consistent manner remains absolutely critical to safeguarding the resilience of our banking system. Thank you.
Okay, fabulous. Thank you, Governor Coase. Thank you, Governor Bailey. This concludes the public broadcast component of today's session. Those of you online, we appreciate you tuning in, and we will now transition to the rest of our program.